Guys, I have a story.
Bring it
A
on.
story. So, about 2 years ago, I got a client, a referral from another client, and she told me this lady wants insurance. You know, she lives with her niece, and her parents were both late. I was excited. Of course, it's a referral, so I went to the client's office. Then we did the underwriting. Like this was a very ready client, so she paid me like same day and everything, and I submitted all the paperwork for underwriting.
Mm.
I know at this time
Yes.
the children only cover was already in the market. Like you didn't need to be covered with the parents,
Wow.
or a guardian.
So she took a health cover for the child
a
alone?
health insurance cover for the child alone.
Yes.
So upon submission, um, the parents, the underwriter was like, but the parent on the birth certificate is not the parent who is submitting, the other KYC documents.
So the ID, the PIN,
ID, the
we're not
PIN,
tallying.
yeah. So I was like, you know what? This child, her parents are late. She now lives with her aunt, who is now taking care of her, and she has, an insurable interest on this child. Like this child, when she's sick, she goes to hospital. She's the one who has to pay, and the insurance said, no, we are not covering that. They declined because they wanted proof of legal guardianship. Either something from the magistrate or adoption papers, just something to show that this child is now in her auntie's custody. And now that brings us to our topic of today. We are discussing the principle of
insurable interest.
Yes.
Welcome to the Insurance Hangout podcast with me, Mama Bima Kenya,
and your super agent Angie Gondi.
And today, Maendeleo galore, guys. We are finally on video, so you can catch us on YouTube. Okay, and please remember to subscribe and ring the bell and share with your friends. And you can also catch us on your favorite podcast platform. This is the 6th episode, and today we'll be talking about the principle of insurable interest.
Yes.
Please define for us, what does it mean to have an insurable interest?
Okay, as you may know, and insurance is actually meant to come in to cover for any financial loss that you may experience. Okay, so when we say insurable interest, any insurance that you take up, you must have an economic stake in it. Yes. That has whether either the loss of it or the distraction or the absence of it will actually puncture you financially.
Yes.
So like in my client's case, the one that I was explaining, she had an insurable interest, yes, but there was no proof of it.
Yes.
Okay.
So in other words, also, your stake, your claim to whatever you are taking insurance on, then it needs to be legally recognized.
Binding. Yes.
And this, this takes me to, like for your job, for example, I'm so excited that actually Kenyans are waking up to the fact that you can actually insure your job. You can insure yourself against job loss, especially through being declared redundant or retrenchment. And the reason why you're able actually to take up, a retrenchment insurance from, your preferred, say, insurance underwriter through your bank is because you actually do stand to lose financially if you were to lose your job. Okay, sure. So I find that that's also a really, a good example of what it means to have an insurable interest, because that job is the one that puts food on your table, pays for school fee for your children. So if you lose that job, you actually stand to lose financially.
Let me ask you.
Yes.
So would you take insurance for my car on my behalf? Do you have an insurable interest?
There's no underwriter who will give me a cover.
Because we are friends, and you feel like, you know what?
Yes.
I can pay for you the premiums let me put these things under my name.
Not happening. And I think that's why, like, you find, you know, a client has purchased a vehicle and it still reads what? Dave Kim Motors. You know, and when you go to the insurance company, or if you go now, when you go to your agent, they insist that please show us proof that one, this is your vehicle, and you have even initiated the process of transferring the logbook into your name. Because I mean, think about it. If that car was to get an accident, and who would be paid? You know, and it's a write-off. Like, who would be paid that money? Think about it. You know, is it Dave Kim or is it you?
Is it you? Because what the document shows is that this car belongs to Angie, yet it's Charlene who has paid for it.
Yes.
The insurance will actually want to pay me as the owner, yet Charlene, you know, it's Charlene who took the stake for that.
Yes.
Okay.
So that's why nowadays you find like motor underwriters, they've really tightened the rules, you know, like even if you come ask for a cover, maybe they'll give you something temporary for a week or two and insist like we need now to get the logbook in the client's name.
In the client's name, yeah. And it's the same thing like with life insurance, you know, you must have an insurable interest, okay?
Yes.
So for example, like last expense policies, those are life insurance covers.
Yes.
And I can't take cover for somebody else's mother, you know, or somebody else's spouse, because in the event that in the event of, you know, my spouse's death, then I will actually lose financially.
Yes.
Right?
Yes.
Because of the income that comes in from my spouse.
Yes. And you see, even with Angie, we are tight, you know, hey, BFFs, right? But we can't go and decide we are taking a joint life insurance cover, like on one premise.
On one premise, because I don't feed her.
Yes.
I don't pay her bills. So anything that happens to me will not, you know, be catastrophic to her financially, and vice versa.
But you see, I can actually go and take a joint life insurance cover with the insurance guy. You know, that's my spouse. You know, I stand to lose.
You stand to lose.
If he was not there, you know, or I stand to lose financially because, you know, this is the gentleman who puts food on our table, you know, who ensures that our daughter is going to school. And that's why, like, with life insurance, you'll always find you can take a life cover on the life of your spouse, also of relatives. And I'm so excited, Angie. There's so much development in the market.
Yes.
Now we have underwriters through whom you can even take life covers even for distant relatives. You're talking of cousins, nephews, nieces, because in some instances you actually find that, you know, being a communal society, you know, you'll find that maybe you are the one who's responsible for your nephews, you know, you're educating them, you're taking, you know, you're the one, you know, feeding them and so on. So at least right now we do have policies that are really opening up, and you can even take a last expense cover, you know, on your extended family.
Cousins.
Yes. Your family, like your father, your parents-in-law, your aging parents and so on. Because really, let's think about it. Like when we lose our parents, it's really us, you know, who are burdened with the arrangements, you know, the farewell arrangements. So at least now we have policies that are allowing us to actually take up a cover for relatives who are dependent on us.
On us,
yes.
Yeah. Oh, okay.
And like the relationship, Angie, when we think of the relationship between like a creditor, you know, like the banks.
Yeah, like the banks. Majority of you have taken loans,
Yes.
And there's always on your loan application, there's the credit life.
Yes, yes.
It's because upon your death or if anything happens to you, the financier is actually going to suffer a financial loss for that.
Yes.
So they have to safeguard against that. So at that point, like the bank, you know, the SACCOs, they have the insurable interest
on your life because they need you to continue paying your, repaying your debt to them. Okay. And in this case, and what you find is, let's say it's actually a motor, like a motor loan that you've taken, a car loan. And this insurable interest goes reducing over time, you know, and once you clear, once you clear your loan, then they no longer have a claim to that vehicle. So now that insurable interest comes to an end.
So, and you also see things like what is this company? Platinum. Credit.
Yes.
Or let me just say the credit companies.
Yes. The microfinance.
The microfinances. Yeah. So mainly like when you're taking insurance, let's say I'm already insuring your car.
Yes.
And you decide you want to take up a loan with them.
Yes.
Most times they'll tell you, because we can't take a credit life.
Yes.
The car is actually what is the asset, you know. So let us have a joint insurance with you.
Yeah.
Yeah. So that in the event of any loss, we can also be paid. Yeah.
Yes. Yes.
The insurance confirmations that in case of anything, then if it's a write-off, then 50% of the money will be paid to this other person and 50% will be paid to the other person. It's because they have an insurable interest on that vehicle together with the borrower until you meet your debt obligation.
Yes. Yeah. And actually, this reminds me, there's an instance where I can take a cover with you and have insurable interest. For example, we are business partners, okay? So in a partnership, for example, there's a policy called Keyman Insurance, you know, that we can take to ensure that should I lose my partner or vice versa, then the business doesn't come down. Like her beneficiaries don't just come and pull out the shares in the business and it crumbles. So because we have this partnership and business that we are running together, now in that instance, I actually do have insurable interest because if my partner is not there, my business partner is not there, I actually stand to lose massively, that is financially.
And I think, you know what, we should call upon, you know, business partners. Please, this is something that you really need to consider because we have like real life scenarios where one partner pulled out.
Yes.
Okay, really didn't pull out, but upon death, the business was crippled.
Yes.
Like it went on its knees because there was no prior planning to, you know, the eventuality of death of a partner.
Yes.
You know?
Yes.
So it doesn't just affect families, it also affects businesses.
Yes.
You know?
Yes. And really, Keyman Insurance is affordable, guys. Keyman Insurance is basically a term life assurance cover.
Yeah.
You get. And it stands with you. Should you lose your business partner? Should one of the partners be diagnosed with a critical illness? Should you become permanently and totally disabled? I mean, it's time that, you know, as you are giving your all into your business, also look for ways to ensure that, you know, you are protected. There's that continuity, business continuity. Yes.
You know, because we're out here building, you know, legacies. Yeah. You want to build your brand that goes beyond you. Yes. And even if like your partner, you know, you get paid because of that, then you must also just have it on your own life.
Yes.
So that your generations can also just, you know, continue with your business and, you know, just grow that brand beyond years, beyond generations.
Yes.
Yeah.
Yes. Yes, and that's it on the matter of insurable interest.
It's a very simple principle that guides us.
Yes.
Yeah.
And that governs forms of insurance coverage, by the way. So for you to get an insurance policy, then you have to show that you stand to lose financially. Should the person whom you're insuring or should the like the property that you're insuring
get damaged, you know, in case of any loss.
Yes.
There's a stake. There's a financial stake.
Yes. Yeah. So that's it from us. I'm Mama Bima Kenya.
And I'm your super agent, Angie Gondi. Thank you for being with us today. Until next time.
See ya.